update to the YouTubers as well, so they know what's going on. All right, so we are now live on YouTube. All right, YouTubers, just doing an update on my tablet real quick, and we will start in a second. All right, has the test changed since the release of the new book? Nope, there shouldn't be many changes, no. Jose, is this still a delay? I don't know. If you wrote it right now, there's no delay. Well, this book is new. It's the book that I'm using, but I was using Dearborn before, the Dearborn book. They updated to 14th edition. Minor changes, not many. So not something that says the whole world has changed. Let's teach new practices of real estate. No. I just chose this book as I think it's better, this book, than anything else. All right, guys, should be on your screen right now for you guys to check in. So is it okay to review last year's YouTube videos? Yeah. Okay. Did everybody check in? Give me thumbs up if you haven't checked it. Have not tricked you guys. If you haven't. All right. Cool. So it looks like we are 100% right now. Let's see. All right. So initiating a mortgage loan. Has anybody ever applied for a loan before? Anybody applied for a loan before? Okay, Marlon. Great. Joshua says student loans. Student loans are the biggest joke ever. For everything in life, if you want to apply for a loan, they ask you for a million things. For a student loan, here, take it. I know you don't understand financing, but take it. Right? And then you're stuck with it. You cannot even go bankrupt like you didn't understand it. Nope. In 1983, I believe, they ruled out that you can't put student loans or federal student loans into a bankruptcy. So if everything else is bad in your life, that's the one thing you can't get rid of. Crazy, right? Anyway, so Marlon says pre-approval. Pre-approval is what exactly? What do you know about pre-approval? Yes, you can open 12 credit cards and do that. Yeah. Pre-approved for a certain amount. Okay, but all right. So my question was, mortgage application. So you get a pre-approval from it. That's what you're looking for. Absolutely, that's what everybody wants. But how do we initiate the mortgage loan? It starts with an application. If you've ever applied for a loan, you will know that they ask you for your name, date of birth, your social, your address, your blood type, your kids' names, what's the period that you have, what's your neighbor's information, right? They want to know everything about you, right? Your race, your color, like your gender, like that changes anything, right? Oh no, those are informational only. You don't have to answer those. But if you do answer those, it affects your loan. Crazy. Anyway, so for a loan application to start, you guys need to go to a lender, and that lender is going to make you fill out the loan application, which is called a 1003. And that's because most lenders they use, and we'll talk about it better tomorrow, they use a uniform residential loan application that was created by Fannie Mae. Now, again, we'll talk about Fannie Mae more tomorrow, but this standard loan application is now used by almost all lenders. And they ask you for this information: property info, borrower info, and supporting docs. Key. Okay? Borrower's info, everything is going to be there, whether you're purchasing, refinancing, or anything else. They ask you for all this stuff. Supporting documentation, which will be after, will be based on the appraisal report, which includes obviously age and year built of the property. And if you're refinancing, they want to know original cost, current balance, and year acquired. But appraisal, purchase contract, credit report, income, and employment verification. These are key when applying for a mortgage loan. They want to make sure that you can pay it off, right? That you're not going to default. Okay? Now, why do they ask for all this information? Why do they ask for almost everything, including blood type and your firstborn and everything? Why do they ask for that? Because they're trying to do what's called underwriting, and underwriting is assessing the risk, correct? They're trying to figure out, if I give you this loan, if I accept you as the borrower, right? How long will it take before you stop paying me? That's pretty much what they're figuring out. If you don't have too much debt, and you have a good job, and you have good, decent credit, well, it looks like you might take the whole 30 years or even refinance, pay us off sooner. But if you have a low credit score and you have high debts, and I give you the money, well, you might be just 2 months into the loan before you stop paying. So that's how they kind of assess the risk. It's called underwriting. Okay, that's why they need all the information to calculate. Now they're going to calculate the, again, ability to repay the loan. Another thing that's key is you're buying a house for $300,000, but is it worth $300,000? They're going to appraise the property, because if it's not worth $300,000, if it's worth less, and you stop paying, when they go to foreclose on you, what's going to happen? How much are they going to recover? Or you stop paying, but there's equity, so you want to sell it. Are you able to sell it quickly? Well, if it doesn't appraise, you're stuck with it. There's short sales, there's other alternatives, but in the immediate answer, which is selling it, you won't be able to, right? And then also to determine the terms of the loan. So we agreed that you were a solid buyer, right? We agreed that the property appraises. Here are the terms of the loan. The best loan for you is going to be a 30-year fixed. Or the best loan for your situation is going to be a 5-year fixed with a 25 variable, for instance. All right, so they're going to analyze all that stuff and give you a proposal that matches your current financial situation. Okay. Now, qualifications. Marlon, you mentioned something that usually a lot of people mention differently, right? You mentioned pre-approval. Does anybody know the difference between a pre-approval and a pre-qualification, the word qualification? Does anybody know the difference between these? Pre-approval and pre-qualification. The mics are on, so if you guys want to unmute anybody that wants to answer, it's fine. So let's see. If you qualify, you meet their standards? Question mark. All right, Josh, qualify means you might, and approval means you will. You will what? It's something along those lines, but you will what? And then Ron says, qualify means you have the opportunity. Approval means you can already seize that opportunity. Okay, Eminem, not bad. Okay, that seized the moment. It's almost like that. You're right in the analogy, but it's if you're pre-approved, the bank has verified all your information. The bank knows your W-2s, your pay stubs, your tax returns, and your credit score. They know you. So that you get pre-approved because they verified everything. So yes, you can take advantage of the opportunity because you got something solid. So Josh was saying you will, right? You will be able to get the loan. While pre-qualification is you call me up and say, hey, Bruno, let's say I'm a mortgage guy. Hey, Bruno, I got like a 720 score and I make $100,000 a year. What do I qualify for? And I ask you a few questions over the phone, but I'm not seeing anything. I'm not verifying anything. If I'm not verifying, how strong is this pre-qualification? Right? And this is what hurts when people are in the business for so long and still call a pre-approval a pre-qualification and a pre-qualification a pre-approval. People switch the terms, just like mortgagor and mortgagee, switch the terms all the time. Pre-approval means we verified everything. And you are now fully qualified to buy the house if nothing changes. Okay? So we checked your employment, checked your income, check your taxes, check everything. You are good. But right before closing, they check everything again. And you might not be qualified or approved at all. So it's key that you guys remember, remind your clients. Congratulations on getting pre-approved based on your current financial situation. Therefore, over the next few months, until we close, do not change jobs. Do not use your credit cards other than what you have right now. So try to stay within the same numbers or better. Okay? And please do not sign for any loans. Like, don't buy a car because you got approved for a $400,000 house. Okay? Believe me, people do this. They have a pre-approval for a $400,000 house. They run for a $40,000 car. And you're probably thinking, well, $40,000 versus $400,000, what's the difference? Like, how is that going to affect my client? It does. See, we're going to talk about qualifying ratios later on, right? And one thing you need to remember is that a $40,000 car equals roughly $600 a month in payments. Now, I have a client right now that his problem is he has $800 to pay every month to a Discover card. The $800 that he's paying is hurting him from being able to buy a $400,000 house versus buying the $300,000. So, I mean, he wanted to buy a $400,000, he's buying a $300,000. This is a true story happening right now with one of my clients because he has this debt. What you need to remember is this. For every $60, okay, not for state exam, but in real life, you need to remember this, okay? For every $60, of monthly obligation, okay, equals $10,000 loss in purchasing power. Okay, $10,000 loss in purchasing power. If this car payment is not here, you would qualify for $100,000 more in house. So let's say you're pre-approved for $300,000. Congratulations. Oh, but the house I really like is $380,000. Well, we got to get rid of the car. Then you qualify for it. Simple as that. Okay. That's why a lot of lenders, one of the things they look at is how many more payments do you have on the car? So if you have only 10 payments left on the car, sometimes they can ignore that $600 because it's less than a year. You're going to be done with it. But if it's more than 10 payments or so, then they have to use this number, and your purchasing power just decreased by $100,000. All right. So Mr. and Mrs. Buyer, again, thank you very much for choosing me, and congratulations on getting the pre-approval on a $300,000 or $400,000 house, whatever. Make sure over the next couple of months, do not use your credit cards, do not change your jobs, and please don't sign for any loan, whether it's a car loan, student loan, personal loan. Do not sign, do not gift money, do not co-sign for anybody. True story as well. I had a client that delayed almost 6 months in closing because she signed for her brother. She was a co-signer, I'm sorry, for her brother in the car. Now, as much as you try to explain it's not my car, it's on your credit. It delays everything. All right, it forces you to do other things so your score goes up. Right, your DTIs go up and stuff like that. All right, so you guys really need to be able to explain this to your clients. Now, another thing we have with the underwriting, and I already mentioned that before, is to further protect the lender against loss, we have something called LTV, or loan to value ratio. Okay, what is loan to value ratio? You guys remember I told you earlier that when we were talking about points, I said you're buying a house of $120,000, but you're putting $20,000 down, right? And the balance was the loan. Okay. Why are we putting $20,000? Because that's what the bank required as a down payment, right? Because their maximum loan to value was whatever percentage. In an FHA loan, they require 3.5% down. The maximum loan that they'll give you against the purchase price is 96.5% of the purchase. Making numbers simple, right? Making numbers simple. A mortgage that's a FHA. Hold on. Okay, mortgage that's FHA. Let's say $100,000. Simple numbers. You have to come up with 3.5%. That means your loan is $96,500. Your down payment was 3.5%. So that means that your LTV, let's switch this real quick, is 96. This is LTV, loan to value ratio. It's the difference between the purchase and the down payment is the LTV. Just like down payment is the difference between purchase and the loan amount. Okay, there's always 100%. This is the value, because usually people buy at value. They don't buy more or less, usually somewhere around value. But it could be the purchase price. And then it's minus LTV, let's say 5%, equals 95% down payments. Okay? Sorry. My bad. Hold on. I was giving the reverse. Minus 5% down payment equals, that would have been awful. 95% LTV. So what is the loan amount if we have 95% over here? The loan amount would have been $95,000. What would be the down payment? $5,000. Okay? Now, The safer side, as we said before, is the 80%. If the LTV is 80%, how much is your down payment on the $100,000? $20,000. Easy. If you put less than that, what do they ask for? If you put less than the required 20%, you got PMI. If it's conventional, what about if it's FHA? MIP. Perfect. All right, so that's it. So a quick review of the previous session, right? That's it. Now, how do you qualify for a mortgage loan? How do you qualify for a mortgage loan? Well, the first thing we're going to look at is your income qualification, cash qualification, net worth, and then finally credit. Because your credit really does not matter if you don't have stability. And your stability at the end really does not matter if you have bad credit. True story. The person that has the $800 to pay to discover, their credit is almost $800. And they don't qualify for the house they want. They make over $80,000 a year. And they don't qualify for the house they want. If that Discover card was not there, they would have been stable enough and had almost perfect credit, right, to buy the house they wanted. So it's a combination of things, right? And then if everything goes well, they give you the loan commitment, that pre-approval. We're going to go briefly over this because I have a chapter just for this, but what is Equal Credit Opportunity Act? Can anybody tell me that? Equal Credit Opportunity Act. What is it about? Equal Credit Opportunity Act. Prohibits discrimination. Yes. Sebastian, come on, man. Credit score? No. The Equal Credit Opportunity Act means you need to be discriminating to everybody equally. No? It means you cannot discriminate. You got to treat everybody equally, right? Everybody's the same. Simple. Everybody is the same. Okay. So what's the point of asking for gender and age? What's the point of asking for gender? So, Dre, gender and, so the age is different. Gender really does not qualify you. Age goes into a risk factor, and you might be able to discriminate based on that. But the things that they cannot discriminate against is gender, race, creed, right? We're going to go over this right here, even though we have in detail in a different chapter. If you're have kids, for instance, you're in a certain location, right? They cannot discriminate against that. So if again, we're going to talk about that later on. Andrea, the older you are, the less credit you have. Maybe. Actually, usually the younger you are, the more irresponsible you are, because you don't understand credit. And there's actually a right number, right? There's actually a right number in like age. There's a right number where most people around that age bracket do not default, as an example. So they look at that. The younger you are, most likely you don't know how to manage your money, so you could potentially default. So there's a tiny risk factor to that. And then, unfortunately, some lenders do look at color as a risk factor, religion as a risk factor, gender as a risk factor, just like insurance companies do. Because, at least for the gender, right? That's why, let's say you have a male and a female of the same age, the female pays less in life insurance, as an example. So they do give different attributes to it. Can they reject you based on it? Definitely not. But they give different attributes. Should they do that? Nope. Brenda says, you got to see everybody green, correct? Yes. Everybody is green. Why? Because if you treat them right, and if you uphold their interest, you make greens. So make sure you also look at them as green in the right sense, not just, hey, I'm going to make money out of this. No. I'm going to help this client, and in return, what do I get? Money, the greens. All right, but we'll have another chapter for that. All right, next page. We did talk about this already. As far as qualifying the borrower, we're going to look at the current income, right? And assets. We're going to look at the current employment status, credit history, monthly payment of the mortgage, monthly payments being made on other loans on the same property if you're refinancing, monthly payments made on other related mortgage expenses, other debts like a car or personal loans, and then the monthly debt payments compared to monthly income. This is where everything gets screwed. This is the $800 I was telling you, or the $600 that will affect your purchasing power. You can have great credit, great income. You have too many expenses compared to your income. That's it. This is called debt to income ratio, or DTI. Okay, DTI. Debt to income. If you have too much debt compared to the income you have, you won't qualify. Okay. But that's the thing about this this country, right? It gives you so many benefits, right? It gives you so many benefits, like the ease of credit. They'll approve you for a $10,000 car, and cards, right? And you think, I can swipe this card as many times as I want until $10,000. Wrong. It's a $10,000 cards, but make sure you don't go above $3,000. Otherwise, your credit starts dropping. If you're below 30% of usage, you have great credit. You go above 30% of usage to up to 50%, you're medium risk credit. 50% and above, oh, you're done. That's it. You're in the 500s once you start going above 50% usage of your credit. Okay, so it sucks because they give you the ease of getting the credit cards, but then they don't allow you to use the whole thing. They give you a number that limits you. All right. Now, all this is related to the ability to repay. That's what they analyze in underwriting. And if you have the ability to repay, if you're not a risky, then you're going to have great terms. If you're a riskier loan, then they're going to have really bad terms for you, which also doesn't make much sense because, right? Does it make sense? If you have bad credit and you're trying to start all over again, why would you give me a higher interest rate? Right? Like you want me not to start over again, almost, right? But it's them trying to, if you see right here, is them trying to, for instance, with interest only, right here. If it's a riskier loan, interest only, they're saying, hey, pay us interest, which is the fee, pay us up front as much as we can get. And worst case scenario, the principal will recover another way somehow. But at least our part, we got it. So the riskier the loan is, the more upfront benefit the lender is looking for. And hopefully you'll last long enough to refinance with another bank paying us off, right? And now you have great credit somewhere else. That's the thought behind it. All right. Now, qualified mortgages. So a qualified mortgage is one that meets the ability to repay, where you're safe. Has certain features, is not allowed to have others. There are exceptions to these rules for certain kinds of small lenders. Issuing a qualified mortgage gives the lender certain legal protections in case the borrower fails to repay the loan. A qualified mortgage does not allow interest-only periods. Okay? A qualified mortgage does not allow negative amortization. Qualified mortgage does not allow balloon payments, loan terms longer than 30 years, or excessive upfront points or fees. Here's what you got to remember about interest only. Interest only, as the name says, you're only paying interest, but you owe the full amount. You owe the whole principal amount that you borrowed. It's interest only while you're paying, and at the end of it, you didn't amortize or drop the balance of the loan at all. So if you borrowed $300,000 and 5 years later on this interest only, you're going to owe the same $300,000. Principal was not affected. A negative amortization, the name already says negative, right? That means that every payment you're sending in, instead of being beneficial to you, is going against you. You're like, why would I make payments then? How is every payment I'm making in going against me? Because you're making less than what's required to reduce the loan. See, interest only, you're paying interest. Negative amortization, you're paying less than interest. And if it's less than interest, then they're adding to your principal amount, that difference. So, long story short, in this example, right, making it simple, if my payment was $1,000 interest only, right, and I send $800 of the interest, then I owe the full principal plus $200 of interest every month. That money is added to the principal amount. So at the end of a year, 2 years, 3 years, 5 years, 10 years, instead of paying it down, it's going up. I'm owing more and more and more to the bank. Do these products exist today? They're not as common anymore. Up to 2008, these products were being sold like, like water. Like, you need this. It's essential for your body. Have this loan. And they were doing this. That's one of the reasons why people started defaulting. The other reason was like, oh, property's lost value, I don't want to pay. Right? That's one of the reasons. But the fact that you keep on paying, and you still owe more than what you borrowed, what would you do? What would you do, guys, if you kept on paying on a loan, and after 3, 4, 5 years you owe more than what you borrowed initially? Anyone? Steph says, I'll cry. A lot of people cried. Unfortunately, a lot of people, what you guys, I hope you don't get affected by this, but it's the reality. A lot of people in 2010, 11, and 12 killed themselves. They didn't just cry. They killed themselves because their whole life savings, everything they were doing was right on that property. And then the market crashed, 401ks were destroyed, house is not worth it. What did I do in my life? They killed, there's these, and there was not more than, it was not once, it was not twice. A lot of these happened across the world where they killed the entire family and then killed themselves. It's sad. It's crazy. Now, a lot of you are writing refinance. A lot of people could not refinance because the property went down in value. So now they're stuck. That's where loan modification short sales became so hot from 2009 till 2013, 14. It was like the hot market right there. I was part of it. I was helping people not to lose their homes by trying to help them. Okay? But some people, there's nothing you could do. So yeah, a lot of people stopped paying. They understood, right? Stopped paying and they said, hey, the banks are taking advantage of us. They knew we could not afford this. Maybe they didn't predict what happened to the market, okay? But they knew we cannot afford it even in the long run. So they stopped paying. And they collected rents. Remember I told you that some of my clients were up to 10 years in their houses? Up to 10 years collecting rents. Imagine that. But I also have other people that try to keep up with the payments, and their whole retirement income was dumped into a mortgage payment that they would never get out of. That's why a lot of people kill themselves. Their entire life savings, there. 401k, gone. House, undervalued. Crazy, right? Andrea M says, remember in Portugal with yeah. So with that bank, here was Countrywide and Washington Mutual. These are banks that are created to fail, unfortunately. They existed for a short period of time for the purpose of failing. All right? Anyway, that's the first two. Now, are the first two, hashtag sad, are the first two, like the interest only and the negative amortization, are these bad loans? Anybody? Are these bad loans? Should they even exist? Anybody? They should need? Oh, not, okay. Andrea M says a loan is always bad. Not always. Ron, he said yes. Should they exist? Then let me know why. You pay more with fees and taxes. Nope, because Andrea, the good thing about loans is that at least you can deduct interest. So there's great advantages, and depending on what you're buying, there's great advantages, tax advantages. We'll talk about that in a different chapter. Ron wrote 2 willing parties. Yeah, 2 willing parties. That means, I like the way you put it, 2 willing. That means they understand what they're doing. Correct? The problem with the majority of the people that I was explaining before did not understand what they were doing. They were getting put into a loan that the payment was so low on a monthly basis compared to everybody else that it's kind of like, hey, you like chocolate? Here, have it. You know? And I'm a fiend for chocolate. I'm crazy for chocolate. I'll kill for chocolate. I'm letting you know right now. Don't stand in front of me and chocolate, because I will get you out of the way in any way, shape, or form I can. All right, Dre? No, we're fighting. Anyway, so it's literally what it is. That's why they created also teaser rates. Look right here. Teaser rates are temporarily low rates. It's literally, as it says, it's a teaser. And here's the chocolate. Come and get it. And then they give you that loan. Right? They give you that loan. And then you don't understand, because you just got the chocolate, you don't understand that that's bad for you. Right? In this example, chocolate is great. Side note. But you don't understand, and boom, once it hits you, that's when things go down the drain. There's no way to come back from it. But are these loans good loans? Should they exist? Should they not exist? If there's 2 willing parties, most hard money or private lending or lending for construction purposes are interest only. Why? Low payments. What's the advantage of getting into an interest only for construction? These are short-term loans. Okay? If there's short-term loans, why not? I'm doing construction. I don't need to have a big bulky loan. I need to have the lowest payment possible while construction is going on, so then I can rent it and start recuperating and refinance. You understand? So interest only is great. Negative amortization, as I said, you're paying less than interest. So it's even worse in terms of loan itself if it's for a long term. But for short term, instead of $1,000 a month, I'm paying $800. I want negative amortization. How much am I going to lose in 1 year? Do you understand? So all these loan products are great. So Marlon just wrote for investors. Yeah. All these loan products are great, guys. When you talk to a client and they're telling you that they're getting an interest-only loan or they're getting a negative amortization loan or whatever it is, or you see it, let them know. Do you intend to stay here more than 5 years? Because if so, then you need to go into a fixed rate or fully understand that you have to refinance ASAP. It's great to get you into the house, but you need to refi as soon as possible to a fixed rate loan. Are you guys understanding this? Knowing the difference between them is great. First two, short-term ownership. Okay? Hold on. I got a message here from Josh. These types of loans of predatory nature are predatory in nature, but it's hard to argue that they shouldn't exist. I think the question is, how can we better educate people not to fall into these scams? So again, they're not a scam depending on the purpose. Okay? I do a lot of private lending and I borrow a lot of money for flips. I don't want a 30-year loan. I want a 6 months to a year, 2 years loan. So I understand that it's high interest compared to another type of loan because it's also high risk for the lender. So it's a matter of what is the purpose. Everything in life is great. Everything is perfect, I think. But it's not perfect for everybody. It's not perfect for every situation. What works for me, Josh, might not work for you. You understand? If I go to Bank of America and ask money to buy, fix, and flip a property, Bank of America is going to say, yeah, we got to run credit. We have to appraise the property. We have to check title. We have to, like 3 months later, I already lost the opportunity I needed to buy. You understand? Where private lending, as an example, interest only, private lending interest only, they'll tell you in 24 to 48 hours, they tell you, hey, looks like a good deal, let's go. Right? So every product is great depending on what you're doing. So education, as you wrote, so part of it I agree, the scam part I don't. Education is key. And back in 2003, 4, 5, 6, and 7, even up to 8, they were not explaining anything to the clients. That was the problem. So you're scamming if you're not explaining. That is where I would put the word scam. If you're not explaining how this happens. Okay? The product itself, not a scam. Not explaining to somebody that you know. Right? It's like reverse mortgage. Does anybody know what a reverse mortgage is? I'll read it in a second. Does anybody know what a reverse mortgage is? No? All right. So reverse mortgage is when you're over 65 and you have equity in your house, the bank starts paying you versus you paying the bank. Who wouldn't like that? Where the bank pays you instead of you paying the bank. Right? Except a lot of people don't understand, especially because they're seniors now. A lot of people don't understand that you're losing the interest in your property. Now the property belongs to the bank until you pay off the loan, and sometimes there's no way to pay off the loan. Now the house does not go to your heirs, it goes to the bank because they have to sell it to satisfy what they've been paying you. Do you understand? But for a senior citizen that's on a fixed income, and we have plenty, Social Security sucks for a lot of people, $800 a month sometimes. Go ahead, try to survive on $800 a month in New Jersey. Right? They have to do something. So the product works as long as people understand what it is for. I understand if I'm a senior citizen, I understand that I'm going to lose the property, right? When I die or when I move out, I don't keep the property. I'm going to lose it because the bank has been paying me. It's an annuity, and the security for that annuity or the investment was my property. You understand? So I'll know up front that that's what they'll do. But if nobody explains to me, if I'm not aware, then you can say scam or misleading. Yeah. Like a retirement. Well, it's an alternative to the current retirement situation. All right, so you had wrote, sorry. But if I perpetrate that these loans work for people like Ron, and what do you mean people like Ron? Sorry, I didn't get that. Is there something wrong with Ron? People like Ron? Anyway, so then they also work for people like you. Aren't I scamming one of the two parties? Yeah. Again, but that's what I was trying to say. He's like, yeah. Like I was trying to say, we're different, Ron and I, right? If you don't explain to me, right, what the product is and how it benefits me and what the risks are, yeah. But it's also the same thing as realtors, because we're talking about mortgage. As a salesperson, I come up to you, Josh, and I say, hey, look, market is going crazy in Newark. There's a new house that just got listed for $920,000. It's a 3-family. Go for it. What kind of person am I? If I'm telling you to buy an almost $1 million house, like if you understand the risks, let's buy. I have to explain to you. I have to explain to you that rent roll right now, or whatever each unit brings, might not be sufficient to cover the mortgage. So it's totally up to you if you still want to buy in Newark a 3-family, but it's up to you. It's not my commission that's at stake here. It's your life, because my commission is for the closing. It's a 3-month process, but you, it's a lifetime maybe. Right? Lifetime if it works, and lifetime of damage if it doesn't. So for either for mortgages or in the sale of a house, the key is explaining. Disclosure, disclosure, disclosure. Understanding these products is key. You guys got it? All right, cool. Next, balloon payments. Balloon payment means larger than normal payment at the end of the loan term. Simply means, and we have this coming up, but simply means that you're used to paying $1,000 a month for 30 years, but your final payment, as an example, is $5,000. It could be $50,000. It could be $1,100. The fact that the final payment is larger than the original monthly payments, that will be, okay, a balloon payment or a balloon mortgage. It's balloon, it's inflated. Okay? So your final payment is larger than the others. Remember that. It might be a question in the exam. Okay? All right, what is generally required? And guys, I know I'm taking a lot of time, but this chapter is so important. There's so many questions for state exam and in real life, so I prefer to go over as many scenarios as I can, okay? What is generally required? That your monthly debt is no more than 43% of pre-tax income. That's your DTI, 43% of pre-tax income. What is pre-tax? Gross. Which is even crazier. Their calculations are based on gross, right? If you make $5,000 a month, your gross is $5,000, your net is $4,200, as an example. But if you make $10,000 a month, your gross is $10,000, but your net is like $7,300. Huge difference, because now you're in a different tax bracket, right? So your take-home money is different as your income goes up. Do you guys understand what I'm getting at here? So they approve you based on the gross amount, not based on the net. Now, qualified mortgages include loans that can be bought by Fannie Mae. We'll talk about this tomorrow. But the debt ratio could even be higher than 43%, right? Move on. I want to focus on debt ratio. Next page. So income qualification. There's two types of debt ratios. There's the front end ratio and there's the back end ratio. Okay? The front end ratio, okay, is your housing expense. Housing expense is your principal, interest, taxes, and insurance. That's your housing expense. How much does it cost for the house? Well, mortgage payment, which is principal and interest, and then how much are the taxes and what's the insurance? Okay. So PITI divided by your gross income will be your income ratio. To identify the maximum monthly income housing expense an income ratio allows, we modify the formula to be gross income times income ratio equals max monthly housing expense. So guys, so simple right now. Figure out, you don't have to answer this, but think about it. You don't have to answer this, but think about what's your gross income multiplied by 31%, and that's how much you can afford for an FHA loan. That's your maximum principal, interest, taxes, and insurance. Okay? If it's $10,000 that you make a month, $3,100 is your maximum loan. Right? Simple as that. Now, can some lenders go above that? Maybe they have their own guidelines. We're going to go over that. But usually for FHA, the ratio is 31% for housing only. Conventional lenders usually is 28%. Okay, so for conventional loans, your maximum mortgage on the same $10,000 would have been $2,800 for conventional loans. You guys good so far? All right, great. So here's an example. If a couple has a combined monthly income of $12,000, guys, this could be a question in the exam. They could say combined monthly. They could say yearly salary, and then you have to divide by 12, because this is all based on monthly. If a couple has a combined income of $12,000 a month, right, and the lender's maximum, look how they gave you all the info in the question. The lender's maximum rate or front-end ratio is 28%, and they have no other debts. How much house can they afford? That's it. Or what is their monthly payment? That's it. Well, they make $12,000. We multiply by the ratio that they indicated in the question, and the max PITI is 3,360. The max that they can afford. Very simple, right? The question is as easy as that. It's either they give you the monthly income or they give you the yearly. You got to remember that this amount is max monthly PITI. Principal, interest, tax, and insurance. So if they say they make $144,000 a year, what do you have to do? Divide by 12. Now you got the monthly, multiply by the 28% or 31 or whatever number they give you. That's it. Okay? How much can they afford? 3,360. The back end ratio, back end, okay, the back end ratio is the debt ratio. So now they're considering PITI plus other loans. PITI plus other loans. So the concept is the same as the previous one. It's just now, hey, do you have a car? Do you have large credit card debts? Do you have a loan that you're paying monthly? You guys remember we talked about this before, right? Now they're adding that. And by the way, it's not like one or the other. They calculate both. Whichever is less, that's the one you get approved for. Okay? Whichever is less is the one you get approved for. Let's figure this out. Guys, on YouTube and Zoom, if you have questions, please stop me and I'll go over it again. So let's go to the same example. By the way, conventional lenders back-end ratio 36%, FHA 43%. In the school or the state exam, these numbers will be given to you, but in real life it's good to know. Okay, if it's an FHA loan or if it's a conventional loan, these are the traditional ratios. Okay, so why is it important to know the back-end ratio? In the same example, they make $12,000, right? Hold on, and the back-end ratio right here, 36%. That means that PITI plus other expenses could not be more than $4,320. Okay? It's the same example. $3,360 is the front-end ratio, housing only. Right? Now, housing plus other debts cannot exceed $4,320. So, if you have $4,320 as a max, then you have a $600 car, then you have another $600 in credit cards, right? What is your maximum mortgage? Anybody? $3,120. How much were we approved if we didn't have debt? $3,360. You guys see how this works now? Which one of these numbers do you think they're going to use? In this case, this one. So they're going to look at it and say, hey, the maximum you can afford is $3,120 a month, and that's equivalent to a house of $400,000 a year, as an example. Right? That's the max that you get approved for. $400,000 with $8,000 taxes. That's the max. So now you come to me and say, hey, Bruno, I want to buy a house. Here's the pre-approval. I'm going to put those numbers. That's the numbers I'm going to use when searching for homes. Oh, no, but I want to buy in this neighborhood. Yeah, kind of like exceeds what you can afford. No, but there's a $300,000 house. Yeah, but the taxes over there are $12,000 and up. Max $8,000 taxes. Guys, this is so important when working with buyers. Right? I'm not training you right now to be realtors, but I think it's essential that you understand the difference between these numbers. Okay? These are key. All right? Cash qualification. Now, one of the things they're going to look at between cash qualification and net worth. One of the things they're going to... Do you have any questions regarding ratios? Guys, please ask. I'm dead serious. If you have questions, ask. I also have a video on YouTube about it, but ask questions. Okay? Cash qualification, net worth, and credit valuation. Under cash qualification, you guys know you're supposed to have money in the bank, right? You cannot just say, hey, I got the down payment, and it's under the mattress, right? If it is, let me know, because I know your address now. I can come visit you when you're not there. Okay? I got a license to see houses, just saying. Anyway, so you got to have the money. Now, the cool thing is that if you don't have the money, you can have somebody gift you the money. Now, Joshua, you just ruined it with Ron. Ron, because you said people like Ron, right? He's not going to give you any money anymore for you to buy a house. You're done. That's it. But Ron, I understand you, so we can work together, all right? That's what it is. Unrelated relatives or friends, they might be able to gift you money. They just have to sign a gift letter that says that gift money is a gift. You guys understand that I just repeated the word gift several times? Why? Because sometimes what people do is like, look, I'll give you the $15,000 you need right now and you pay me back after closing. It's up to you. You have to sign an affidavit that says, this is a gift and I don't expect it back. Okay? You guys understand what I'm trying to say here? Gift letter. So if you don't have the money, somebody can help you. They can gift it to you. Let's say Sebastian, right? You're about to buy a house. Maybe you don't have the money. Your parents, they can say, hey, Sebastian, here's some money. I'm gifting it to you. If they're not co-signing with you, then they can gift you the money. If they're co-signing, then it's the joint cash qualification, right? But if they're not co-signing with you, if it's on you and they say, hey, here's a gift, congratulations on your first house, right? 15,000, 20,000, whatever. You got it? Gift. Net worth. You got to have reserves. Some lenders, they ask for 3 to 6 months reserves of monthly payments. Sorry, for those of you on YouTube, you deserve to see this. So Josh just asked, when is Biden going to gift me all my student loans money? Okay. To address that quickly, whether Biden or anybody else, there's proposals and they need to pass Congress and the House. Good luck with that. Doesn't matter what I say. That's the thing I don't like about presidential races and stuff like that. Like, you already know as soon as it hits Congress, they're going to block it. What's the point? What's the point of promising for you to win, right? Whether it's Trump or Biden or Obama or Clinton, it doesn't really matter. You got a bunch of people there that will say no. Only because I don't like your party, Mr. President. And quite honestly, a lot of stuff that's happening is that. I don't like your party, so I'm going to block any action that you take. I don't care about the American people. I care about the fact that you're not from my party, so reject. And if you guys have not noticed that yet, at least the last 20 years that I've known here in the United States, that's exactly what it's been. Doesn't matter who's running, the other party says no. So, anyway. Sorry, I got upset about politics. Did I ever tell you guys what politics means? Does anybody know? No? Just for fun. So somebody on YouTube tells me that I talk about a lot of stuff that's not real estate related. Just for fun. What does this word mean? Anybody? Many. You got it now? Blood-sucking, right? Things that attach to you. Many blood-sucking things that attach to you. All they're doing is taking your blood. And we're voting for these people, and we're believing in them, and we're buying. It's the funniest thing. I don't care for Trump or Biden or anything. But the funniest thing is I open up a business, right? And I'm the only one that's wearing this. A president is running and people are spending their whole lifetime savings to get the hats, to get the banners, to get the flags and stuff. Like, come support me. Thank you. I appreciate when you do that for my business. Go ahead and vote for somebody that never had your interest in the first place. Anyway. Marlon, you want to know the lesser evil since you wrote that? The lesser evil is you working hard and making things happen. Because neither one of them is coming to save your student loans, Josh. Lesser evil. Don't matter. It's all puppets. All right. Net worth. is having the assets. So 3 to 6 months, you got to have it. Credit evaluation. Credit score, you guys already know. You got to have. They got to get a written credit report on any applicant who submits a completed loan application. Did you guys know that if they deny your loan, they have to not only let you know that you're denied, they have to know which creditor did they pull the info from and give you an opportunity to get the copy of your report from the creditor. So they won't give you the copy, but they have to disclose if it was based on Equifax, TransUnion, or Experian, or if it was all three of them. But they have to give you an opportunity to pull your credit for free based on that dispute. Okay, in writing. Okay, if everything works well, we get what's called the loan commitment. And the loan commitment is that pre-approval that Marlon was talking about before. The loan commitment is, hey, we agree to fund you based on this, this, and that. And there's different ways. There's a firm commitment, there's a lock-in commitment, there's conditional commitments, and so on. A firm commitment is, as it says, straightforward, guaranteed. Here's the interest rate and the amount that we're going to offer you. A lock-in commitment, as it says, we're locking something, right? What are we locking? Interest rates. So what they'll say is, hey, for the next 60, 90, or 120 days, depending on the lender, we are locking the interest rate at 3%. If interests go up, right, you're winning because you're at 3%. If interests go down, sorry, right, it's locked. So the key of having, like right now is a great time to lock in interest rates because interest rates are rising, right? You want to make sure that over the next 3 months, as you're trying to close, the interest rate will not be higher than what you initially sought a loan for. Does that make sense? So you lock in the rate. Okay. Closing a loan, guys, and we should be pretty much done. Yep. Closing a loan. There's two closings that happen at closing. Did you guys know that? 2 closings that happen at closing. One of them is the closing of the loan. The other one is the closing of the transaction. So the closing of the loan is because there's a loan transaction in place, and we have to close that transaction before we move forward. So until the escrow agent, as we have here, until the escrow agent sees, hey, we received the money, we're clear to close, right? The buyer and the seller cannot close their transaction. So 2 transactions are happening. The transaction of the loan and the transaction of the sale. We close the loan, then we close the sale, if a loan exists. So how many closings do we have at closing? 2, if there's a loan. If there's no loan, there's only 1, because it's a cash transaction, we just wire the money. That's it. You guys got it? Cool? Great. Any questions? Going once, going twice. YouTubers, if you have questions, please ask now. Nope. All right, guys. So if you have no questions, we are done. And I know it's a lot of information, but again, that's why I take my time here. Tomorrow we'll go over part 3 and 4 of this. Hopefully we'll finish early because it's not much more information. It's going to be calculations and looking at a closing sheet. But I really, really need you to pay attention. There's a lot of questions here. In the previous book, so Sebastian, you were talking about the previous book, and Mariah as well, Dearborn edition, it took 3 chapters to do this one. Chapter 13, 14, and 15. This one chapter. But I still take my time. Okay? Very, very important. All right, guys. So if you have questions, reach out to me or in the group. Yep. In the group, in the WhatsApp group. YouTubers, reach out to me if you need anything. And I'll see you guys tomorrow. So I hope you enjoy it. All right? Thank you. Good night.